Hello everybody, this is Ron Wheeler, and in today's class we're going to demonstrate the integration of the VectorVest software with the new VectorVest OptionsPro software. The whole concept behind the integration of these two packages is to take trades and trade opportunities from the VectorVest software, and now we're going to judge those to see if they're good options trading candidates. I personally have been trading options since around 2006. I've been trading since 1997. And over the years, I've seen different things that we can do with options and volatility that help us clarify good trading candidates from a good option trading candidate. Now, what I mean by that is I've had trades in my past where I've looked at a stock, I've purchased a stock or I've purchased an option spread, and the stock has increased in price according to my trading strategy, but the option itself did not increase in price. Now, there's reasons behind why these things occur. And what we need to do is we need to understand why that occurs, and we can separate whether it's a good option candidate or just a regularly trading candidate. Now, again, to summarize what I've just talked about right there, a good trading candidate means I can buy the stock, or I can sell the stock, or if it's a neutral market, I just buy and hold. If it's a good options candidate, I can take that stock and place an option trade on it. Now again, not every good trading candidate is going to be an options candidate, and this is what we have to break down. And this is where you're going to really see the power of the VectorVest and the VectorVest OptionsPro. So to that point, I want to first talk about one of the most critical elements of options trading, and that is understanding volatility. As an options trader, there's a couple different types of options trades you can make. There's what's called a debit spread. A debit spread implies that you're giving money, you're paying premium to take the trade. There's also called options or credit spreads. Credit spreads are where you are getting a credit, and essentially if the trade goes in your direction, you're pocketing a credit and they're giving you money to take the trade. How does volatility play into a credit spread versus a debit spread? Now in today's class, I'm going to do two different types of trades. I'm going to cover the covered call, which is a credit spread, and I'm also going to do a bull call spread or a bull call debit spread where you're laying out money up front to take the trade. And we're going to talk about how volatility plays an important role in choosing a candidate. So in the VectorVest OptionsPro, now the way I'm going to cover and the way I'm going to teach today's class is I want to do a little bit of background knowledge first, a little bit of background teaching in the OptionsPro software. Now, once I get done with explaining how volatility plays into options trades, I'm going to go into the VectorVest software, show you how to do a search, and take those candidates from the VectorVest software. These are going to be good trading candidates, and we're going to take those good trading candidates and we're going to analyze them to see how they play out for options potential. So number one, the first thing I want to talk about is volatility. Now on the screen in front of you is a chart of IBM. Inside of the OptionsPro software, we have a few volatility indicators that we can use. The first one I'm going to show you is volatility comparison. I'm going to right-click on my chart. I'm going to move my cursor down to where it says Add Study and just highlight that. Move my cursor to the right. And right in the middle, you'll see DT Volatility Comparison. I'll left-click, and it's going to bring up the Properties menu for DT Volatility Comparison. Now, what this will allow me to do, it's going to show me the historic volatility and how that historic volatility, you can see that menu option at the bottom of your screen, add up to 3 historic volatilities. I'm going to choose the 45-day historic volatility. That's kind of the default that we use for our display. Now on top, we've got 3 options. We've got the mean, the calls, and the puts. Now the top bracket, this is implied volatility. The difference between implied and historic volatility is this. Historic volatility is what the volatility of that stock has been. That means over a course of a year, how much price change has it made? And this is a 45-day average of it. On the top is implied volatility. Implied is what we think the volatility will be over the next 30 days. So what we're going to do is we're going to chart the difference between the volatility implied and the historic. So I'm going to click OK. And on the bottom of my chart now, you'll see DT volatility C comparison, and I'm going to turn on my data window so we can kind of see the values. If I scroll over and just move my crosshair on that last bar, February 6th, you'll notice that the cumulative implied volatility is 18% and the historic is 17.76. Now, what we're looking for is we want to see if the options are inexpensive or if they are expensive. Here's how you do that. You compare the implied versus historical. In a situation where options are going to be cheaply priced, you're going to see that implied volatility, that green line, be very far below the pink line, which is historical. So I'll give you an example. We'll pull up IOC. Now, to pull up a different chart in the OptionsPro software, all I need to do is just start typing on the keyboard. I'm going to hit I on my keyboard, and once I do that, if you take a look in the upper left-hand corner of the chart, you'll see that my cursor is flashing in the symbol window, OC. I'll hit Enter on my keyboard, and that's going to load up a new chart. Now, another thing that I'm going to do for our presentation today is I'm going to go ahead and turn off the crosshairs. Sometimes those can create an artifact. So we'll turn those off. All right. Now take a look at the volatility comparison on the bottom. And remember, the pink is your historical, your green is your implied. When the historical volatility is greater than the implied, remember, implied is what we anticipate over the next 30 days. When that implied volatility is trading below the historical, this particular stock has cheap option pricing. So if you're going to do a debit spread where you have to pay out to actually place the trade, this would be a good candidate for a debit spread because it's a very inexpensive priced option. Now, as we go through the course and we go through this class today, I'm going to show you some scanning criteria in our matrix that'll help you identify very quickly, do we have cheap priced options or do we have more expensive priced options? I'll give you another example. OCR. Take a look at your volatility comparison now. On the bottom, you'll see the green line, which represents implied volatility. Again, that's the next 30-day projection versus the historical. You see that implied is at a much higher level than historical. This is the type of pattern that you'll see when options are expensive. When do you want to trade expensive options? Anytime you're doing a credit, like today we're going to do a covered call. If we're selling the option premium, we want that option premium to be expensive to maximize our return. If we're buying an option, if we're buying a call or we're buying a put, we want that option premium to be inexpensive. So we have scans in our software, in the OptionsPro software, that'll help point out these particular patterns. And I'll show those to you when we get into the integration of the VectorVest. Before I do that, I want to bring up one more point. And I want to bring up one more display window here in the OptionsPro software. The first trading strategy that we're going to cover today is the covered call. Now, with the covered call, a very key component of this, other than the volatility, remember, for a covered call, we're actually going to be selling a call. So if we're selling, we want expensive options. So OCR actually right here, regardless of, I don't know if this is a good trading opportunity because I pulled this chart up at random. It's not from the VectorVest scan or for the Unisearch. So I can't tell you if it's a good candidate as far as a covered call from the direction standpoint, but I can tell you from a selling option premium, this is a really good candidate because this implied volatility is much higher than historical. Now, when you do a covered call, another thing that we have to analyze is what's called the theta decay. Theta of an option is essentially time decay. Every day that we get closer to expiration, an option contract will lose value just on time alone. This has nothing to do with the movement of the market, whether the market goes up, whether the market goes down, has nothing to do with that. It's simply a matter of time. That's why they call it time decay. So I'm going to go ahead and close this chart of OCR, and over on the left-hand side, you'll notice that there's 8 buttons on the screen. There's chart, that's what we were working from when we pulled up that chart of IBM, and we looked at IOC, and we looked at OCR. I'm going to scroll down to the bottom where it says decay, and I'm going to left-click on decay. I'll go ahead and expand that out to the full screen. And this is now what's called a theta decay window. I went ahead and put that symbol in there, OCR, because we already found it on the screen that it was an expensive option. Now, what I want to point out, on the theta decay, you'll see two checks right here. This one occurs on April 21st, and then another one which occurs on May 13th. This is what we refer to as the theta sweet spot. Now, in a covered call, what I need to do is I need to make sure the option contract that I look for to sell that call is what we refer to as in the sweet spot. Now, the reason that we want to do this, the reason why this sweet spot is important, once you get past the sweet spot, so May 13th is the ending point of the sweet spot for the June 21st $60 call. After the sweet spot, you'll notice that the decay or that option value declines rapidly. And if you see the window below it, you've got the theta on top. This is the decay, how much it decays a day, and it's about 25 cents per day. And as that goes day by day, you'll see it increase. Every day, as we get into May, now it's 30 cents. If we go into June 1st, 35 cents. As we get closer and closer to expiration, that option is going to decay in value at a greater and a much more rapid pace. And you can see that on the bottom pane in the option value, where eventually, even if we're at $60, that will have no value based on the decay. Now, for a covered call, I want to choose an option expiration where we're in the sweet spot. If we're too far past it, we're giving up too much value for selling that call. We want to make sure that we're selling a call that's in the sweet spot. So before I do these, before I go into the VectorVest integration, what I always like to do is start looking at my theta decay, because this is going to help me choose which option premium I'm going to be selling. So you can tell right now, the June 21st, if I'm looking to sell a June 21st call, I am way ahead. The sweet spot is not till April 21st into May 13th. So what I'm going to do is I'm going to left click on this drop down, and I'm going to go back 1 month to March 22nd. Okay? Now March 22nd, notice the difference on the theta chart. I only see one time indication, February 11th. If I only see one on the screen, that means I am currently in the sweet spot. March 22nd is a good expiration to sell for a covered call because we are in the sweet spot. If I take one back, let's go to February 22nd, you'll notice that there's no indication of a sweet spot. That means I'm too far past it. Every day I'm losing a greater and greater amount of my option premium as we get closer to expiration. I don't want to sell the February 22nd because it's already losing too much of its value. I want to make sure the option contract that I choose to sell for this covered call is in that sweet spot. Now, Omnicare OCR doesn't have weekly options and only goes February, March. If I switch into something that has a little bit more activity, like let's say Priceline, and again, I'm showing you Priceline not because it's a good covered call candidate per se, just because I want to illustrate the theta decay. All right, so here's Priceline. Here's an April 19th, 2014 call. And you'll notice that the sweet spot is between February 19th and March 12th. So once February 19th comes around, and if you're looking to do covered calls, I would probably switch to the April 19th expiration. I'll take that drop box and let's go back to the March 22nd. And you'll notice the March 22nd, we are in the sweet spot because you only have one time noted. Again, March 22nd is where we want to be with the covered calls because we are at maximum value right now. Okay, now we keep that in mind. Let's just review very quickly what we've covered in the kind of like pre-setup here. We talked a little bit about volatility. Since we're going to do a covered call, I want to focus on expensive priced options. Expensive priced options means my implied volatility is trading at a greater percentage than my historical. Now, because we're doing a covered call, I also want to make sure that we're in the theta sweet spot. So once I know the March 22nd, 2014 expiration is in the sweet spot, I don't need to come back and look at this. I already figured that out. March 22nd, if you got a pen, you can write that down. When we start looking for trading opportunities for the covered call candidates, we're going to use the March 22nd expiration. And then, again, put this in the background. You're also going to be looking for expensive priced options where implied volatility is greater than historical. All right, how do we do this? First thing I'm going to do, I'm going to take us back into the VectorVest program. I'm on the home page. I'm going to do a scan. So from the top, I'm going to choose Unisearch. Now I've already got this set up with VST rockets. Now what I'm going to do here is I'm going to take a list of stocks that VectorVest defines as potential bullish candidates. So I can run my scan, just left click on Run Search. VectorVest is going to do its scan. VectorVest is doing half the work here. It's going to pick direction for us. Now what we need to do is take these stocks that are on the bottom of the screen, Facebook, Tesla, Bank of America, Salesforce.com, based on the VectorVest VST rockets, and you can see I've selected it over here on the left-hand side, these are potential bullish candidates. Now, these are all fine stocks that have a potential bullish move. What we've got to determine next, do these have the potential to place options trades on? Because not every bullish candidate, not every stock that's a good trading opportunity is a good options candidate. Now, from our top menu, where you see Display Top 100, Return Option Rate of Return, now because the screen is at a slightly smaller resolution for our demonstration today, I'm going to have to click on this little menu over here to the right. And what you'll notice, there's a section now for Options Pro. I'm going to go ahead and left-click on Options Pro, and a menu is going to appear on your screen with the Launch Options Trader Pro. From here, we can start pulling up risk graphs, we can look at options chains, or we can just launch the Options Pro software. Now, for our first demonstration, we're going to be doing some covered calls. Now, what I'm doing here, and this is kind of working in the background, when I choose a risk graph for a covered call, it's going to take, and I'll just move this off the screen for a moment, it's going to take this entire list of stocks, Facebook, Tesla, and if I scroll down, it's going to take all those stocks and import them into a list in the Options Pro software. So I'm going to left click on Covered Call because that's the one that we're going to do. Options Pro software is now loaded, and you'll see that it loaded a risk graph for Facebook. That was the first symbol in that list. Now, I'm not going to do much with the risk graph yet, but what I've done is I've integrated, you see over here on the right-hand side, I have integrated that entire Unisearch list into the Options Pro software. Now, this is important because this is my work list that I'm going to go from. The first thing that I need to do is I need to take these candidates and I need to screen them. Are these good potential covered call candidates? Now, remember what we were looking for. What's a good covered call candidate? Anything with expensive option premium. Now, these candidates are pre-screened by VectorVest to be bullish potential stocks. So we already know we've got direction behind us. Now we need to do the options part of it. So down at the bottom of my list, you'll see a Send To column. I'm going to left-click where it says Send To, and one of my options is the matrix. Now, the matrix is the Options Pro scanner, so I'm going to left-click on Matrix, and my matrix window will appear. I'm going to go ahead and make this full screen so it's easier to see for everybody. And this is my scanner. Now, at the top, there's a DT scan. I'm going to go ahead and left-click on that drop-down window. And the final column in there is Advanced Scan. Now, what I'm going to do is I'm going to instruct my matrix to find me expensive option premium. So through this list of advanced scanning, we have all kinds of different option scans that you can do. Since today's course right now is about the covered call, I'm going to go through this menu, and you'll actually see towards the bottom a covered call potential candidate. So I'm going to left-click on covered call potential candidates, and automatically we go through the list. So from that list of 100 symbols, we have 5 potential covered call candidates. Now, the covered call candidate scan is essentially looking for what we showed you earlier. We're looking for charts and we're looking for symbols that have a high implied volatility versus a low historical volatility. Now we can verify this. If I open up a chart, I'll just left click on my chart, and what I can do from here, I'm going to go to Window and Tile Vertically. The reason I'm going to do this tile vertically and show you the window, the chart next to the scanner, oops. The reason I want to show you those both together is because I want you to see what the scanner is looking for. So we'll go to Window, we're going to go to Tile Vertically. Now I'm going to take and use the group function. You see how the group over here is set to gold? I'm going to set the group on the chart to gold. And you don't have to do this, by the way. I'm only doing it to illustrate what the scanner is looking for. We talked about this before, so I'm going to go ahead and add the DT volatility comparison, that same study that we looked at in the beginning portion of the class, where we're comparing historical and implied. Now, these are the 4 candidates that came up in the scan for covered call candidates. So the first one is ALKS. I'm going to click on ALKS and take a look at your volatility comparison. The green line represents implied volatility. The pink line represents implied volatility. Okay? Sorry, reverse that. The pink line represents historical. The green line represents implied volatility. And take a look. This is exactly what we want to see for overpriced options. The green is implied. It's greater than the pink, which is historical. This is the kind of pattern that we want to see. Let's left click on the next one, INCY, and if I want to load that chart, all I need to do is in my matrix screen, I'll just left click on the symbol itself, and you'll notice the chart over there changes. You'll notice again my historical volatility, which is the pink line, much lower than my implied volatility, which is green. Another example of overpriced option premium. Since we're going to be selling calls, this is exactly what we want to see. TQNT, another one, you'll see the same thing. WBMD, WebMD, same concept. Now again, you didn't have to load the chart, you didn't have to split the screen like I did, but what I wanted to illustrate for you is what that scan is looking for. It's looking for those stocks that have high implied volatility compared to a low historic volatility. That way you kind of know what the scan's looking for. Now I want you to take a look. Look at my scan results. I've got 4 symbols. Now look at the symbol list I pulled in from VectorVest. Now these are all good stocks. These are all good bullish potential candidates. But remember what we talked about, one of the first things I brought up. Just because it's got good movement potential and it's a good trading candidate doesn't mean it's a good options candidate. We have a lot of good stocks here that we can trade on the bullish side, but only 4 of them are covered call candidates because of that volatility. So from here, we can start putting together an options trade. I'm going to pull up the risk graph, and this is where we can start laying out the options trade. And I'm going to show you another feature called the probability envelope so we know how to set up our options premium. So I'm going to go ahead and link this to everything else. That way, if I want to split the screen again like I did before, here's my scanner, and here's my options. They're all put together. Now, on the risk graph, I have what's called the spread template. So I'm going to choose from spread template. I'm going to go down to where it says bullish, and I'm going to choose covered call. Now, what the risk graph will do, it's going to go ahead and construct a covered call scenario. We would be buying 100 shares of INCY. We would be selling 1. The 62.50 is the current at-the-money call. Now, the expiration is set to February 22nd. That's our current expiration. If you remember from our, I'll call it homework, we already noted that the March 22nd expiration is the best one because we are in the theta sweet spot. So I'm going to go ahead and choose the March 22nd expiration, and now we can see the risk graph for that particular trade. We would be buying 100 shares at $62.80, and we would be selling 1 March 22nd call at 62 or the 62.50 strike price for $4.90. Now there's a couple ways that we can do a covered call, and we can kind of point this out using the OptionsPro software. I'm going to go ahead and pull up another chart, And I'm going to go ahead and load INCY. And I'm going to make this chart the full screen. And I'm going to pull up another study. I'm going to go to Add Study. And I'm going to go to Probability Envelope. Now, what this probability envelope is going to do, and I'm just going to put a couple checks here. I'm going to turn off weekly options because I only want to do monthlies, and I'll show you this display expiration labels and show you what that means. I'm going to hit apply, and then I'm going to turn off again my cursor. I'm going to pull this chart back. All right. Now, what the probability envelope does, based on the options pricing, based on the current price of the chart, it's giving us an envelope which shows one standard deviation. If you take a look from the current price, this is the current price where that green line is, or that green arrow is. I'm just going to draw a line out from the current price. What we have to do a covered call is we need to sell a call somewhere between the current at the money and somewhere below 71.67. What 71.67 represents is one standard deviation of movement of INCY. So if INCY moves within one standard deviation of the current price, it would be at 71.70, and this green line, the green dotted line, that represents where the option expires in March. So between the current price of $62.95 or $62.50 for the options price, that's an at-the-money call, somewhere between $62.50 and $71.74. Now, for the covered call, we can basically sell premium all the way up to $71.76. But you have to decide as the trader, what type of covered call is this? Is this what's called a buy right? You're buying the stock and you're selling the call right away? If that's the case, you can essentially buy the stock, buy an at-the-money call, because if the stock goes up, you're going to collect the premium that you already sold, and when the stock and when that option expires, they're just going to call the stock from you. And that's fine. You made money on the stock, you made money on the option premium, you're set. If this is a trade where you're doing this with something in your portfolio and you don't want to have the risk of getting that stock called away from you, what we can do is we can sell an out-of-the-money call. And how far out of the money would you go? How far out of the money do you want to go? Well, you would want to go no higher than one standard deviation of 71.70. Now, what you'll notice when you get into the risk graph, I'll go back to my risk graph. So we've got that price, 71.70, that's our maximum price. That's one standard deviation. Let's go back to our risk graph. And you'll notice that the risk graph is set up for an at-the-money call of $62.50. That's going to give us a premium return of $4.90. You can see over here the credit of $5.25. And if that market moves one standard deviation by expiration, that's those green, what I like to call goalposts. You'll see them right there. Those are green vertical lines. As long as the stock reaches that particular, anything above really $62.50 by expiration, you will make the maximum credit of $5.25. Now, if you want to go a little bit out of the money, maybe to protect that stock, because maybe this is something that you already own in your portfolio, we can choose a different or a higher strike price. So let's do a $65 strike. Now, as you go farther out of the money, what you're going to notice is the bid and the ask, the actual price you're going to get back for that option, this one that you're selling, gets lower. So we'll do a $65 one. Well, now it's a $4. If we go out one farther, let's go up to 70, $2.20. So as long as that stock gets to $70 by option expiration, you'll maintain the maximum credit. And you'll notice that the credit goes down in price, $240, $250 for the $70 call, $65 call, $420, and if you do it at the money, which was $62.50, you'll notice that that's the largest amount. So what you have to do now is just take into account of what type of covered call this is going to be. Sell at the money if you just want to go ahead and take the premium and have, and give the stock back. If the premium gets called, no problem. If this is something you're looking to do in a stock that you already own, maybe go a little bit farther out of the money. And that's where that probability envelope really comes into play. You don't want to go any higher than 1 standard deviation. And if you remember, let me go back to that chart. Here's the chart. That 1 standard deviation move was 71.69. That's why I chose that $70 call. You could probably go 72.50 at the most, but you really want to be at or below that 1 standard deviation. Okay? So just to review very quickly what we've done, we took a list of stocks from the VectorVest software. I used the VST Rocket Scan. I imported that list into the OptionsPro. Now, from a list of 100 potential candidates, we narrowed it down with our matrix to 5 stocks: ALKS, HIMX, INCY, TQNT, and WBMD. What we did from there, I showed you the risk graph, and another component is also our probability envelope. What this allows you to do is set a range for where you want to go ahead and do your call, anywhere between at the money, which is right here, to 1 standard deviation, which was 71.67. This is a good candidate to sell any call between those prices. So from a list of 100 stocks, we got 5 candidates. Trade them from there. That's a covered call. Now, what I want to do, I'm going to flip the concept. Instead of doing a credit spread like a covered call, let's do the same procedure, but let's do it for a spread like the bull call debit spread. We're still looking for the same type of market behavior. We're looking for potential bullish candidates. So what I can do, I can work from within that same list, which was right here. I can work from within that same list and use a matrix to find, this time, inexpensive options. Because remember, we're doing a debit spread now. A debit spread, a debit spread means we need to pay premium. Since we're paying, we want to pay the cheapest price possible. So I'm going to go ahead and just kind of start from scratch as if we never came into the OptionsPro software. So I'm going to right-click in the OptionsPro symbol list, and I'm going to say remove all symbols, and I'm going to go back into the VectorVest Unisearch. Now I'm not going to do a new search. I'm just going to go ahead and use VST Rockets because that's a good bullish scan. I'll still keep everything the same. I'll go ahead and just run a new search to see, just to update the list. On top, I'm going to choose OptionsPro, and from my launch page, I'm going to do a bull call spread. So I'm going to click left click on bull call spread, and now I'm going to get a Facebook risk graph for a bull call spread. Now the advantage of a bull call spread, and there's some pros and cons to every option trading strategy, obviously. An advantage to a bull call spread is you're going to be buying an at-the-money call, and you're going to be selling an out-of-the-money call. By selling the call, you're going to get a credit back. That's going to help offset the price of the at-the-money call that you bought. Now, the advantage of a bull call spread is that it's going to make it less expensive to trade it. This works really well on very expensive stocks like Priceline or Google, something that premiums a lot of money. Because by selling that out-of-the-money call, you're going to be getting, again, you're going to be getting a credit that's going to help offset that. That's a good part of the bull call debit. The downside of the bull call debit is you are now locking yourself into a maximum profit. If you were just buying a call outright, you have an unlimited profit potential based on the underlying movement of the stock. By doing the bull call spread, you're locking yourself into a maximum profit. So there's pros and cons like there is to every type of trade. Now, what I want to do, I want to start from scratch again. I'm going to go ahead and just minimize that risk graph. I'm going to pull up another chart. And this is not something you have to do as part of the integration. This is, again, kind of just some pre-work that I want to show you. I'm going to start again with that DT volatility comparison study. Right-click, go to Add Study, DT volatility comparison. I'm going to show the same thing. I'm going to show the green line, which is implied volatility, my pink line, which is historic volatility, and chart that. Now, what I'm looking for in this case, I'm looking for inexpensive options. So I'm going to go back to that one symbol we typed in before, IOC, and this is an example of something that's going to have an inexpensive option. Again, I'm looking for my historical volatility now to be greater than implied. When we were doing covered calls, we wanted it opposite. We wanted historical to be lower than implied. Now we want historical to be greater than implied. And that's kind of what you see here with IOC. The pink line, which is my historical volatility, is very high. My green line, which is the current implied volatility, is very low. This makes for inexpensive options premium. Now, I just wanted to illustrate that on the chart for you so you kind of get an idea of what we're going to look for in our scan. From that same symbol list over on the right that I've pulled in from VectorVest, I'm going to do the same procedure I did for covered call. I'm going to left click on the bottom where it says send to, and I'm going to choose the matrix. If you remember, I went up to the top under Apply DT Scan, scroll down under Advanced Scan. These are all of my option scans, and I'm going to choose one that's pretty apparent right here, stocks with underpriced options. If I left click on stocks with underpriced options, here is a list of stocks with cheap option premium. I've got Energy Transfer Equity, Beam, Under Armour, Green Mountain Coffee Roasters, Akamai Technologies, Michael Kors, and a whole list of stocks that I can choose from. Now again, the whole principle behind what we're doing, we're taking candidates that are good bullish stocks, and now we're fine-tuning them into good potential options candidates. And that's what it's all about. All right. I'm going to also pull in a couple other things on this particular scan that I'm going to show you that were different from covered calls. Because this trade involves kind of two legs, where the covered call was you're buying the stock and you're selling a call. What we're doing with the bull call debit spread is we are buying a call at the money and we are selling a call out of the money. So it's actually a multi-leg spread. We're using two. I'm going to introduce to you another feature of OptionsPro called the skew. Over on the left-hand side of my screen, there's a button for the skew. So if I just click on that, this is going to bring up a skew chart. Now, what the skew chart is going to illustrate for us is the implied volatility of different strikes. Now, by default, it's going to open up to IBM. I'm actually going to link this to my matrix to show you how this works. If you take a look up here at the top, you'll notice that the different expirations are indicated by different color lines. I'm going to take off, well, I'll just illustrate it with the February 7th expiration, the weekly. If you look at the dots on the skew chart, this right here, this dot at 175, represents the $175 call. If I go and connect that over to the right, this is the $177.50 call. That's the volatility. If I go up, this is the implied volatility of the 180 call. Now, in a bull call debit, what I want to see is I want to see a skew where the call that I'm buying has a low volatility and the call that I'm selling has a high volatility. It's called a volatility smirk. And what I want to see is I want to see a line very similar to this. So I'm going to go ahead and tile my screen. I'm going to take off the chart and I'll keep the risk graph in the background. Okay. I'm going to link those two up so I can see both of those together. And as I scroll through the list, you'll see the skews for the particular stock. So I clicked on ETE. ETE is loaded into my skew chart. Now what I'm going to do is very quickly go through these and look for a good volatility skew. I'm going to use the February 22nd expiration. If you want to view the March 1 expiration, that's fine as well. But I'm just going to go through these and see if I can find a chart that has a good volatility skew. And as soon as I see one, I'll point it out to you and show you why it does. That's the February. Let's do the February 22nd. Okay, but do you see how it's flat? Now, you can still do a bull call debit on something with a flat line, But what I want to do is I want to maximize it. I want high volatility on the one that I'm going to sell and low volatility on the one that I'm going to buy. So I'm just going to go through my list and see what I can find. All right, that's February 7th. That's the one that expires on Friday. That's a weekly option, so we're going to not view that one. I'm going to do something that's more out there in time. Michael Kors, let's do February 22nd. Okay, TXI. Okay, TXI. TXI is a good example of what I want to see. Take a look at the volatility near the money. Even if I buy an $80 call on TXI, and if I want to sell the $90 call, look at the skew on that. I am buying very, very low volatility near the money, and the option premium that I'm selling to complete the bull call debit, look at how the volatility has spiked up on TXI. This is exactly where I want to see for a bull call debit. This is a perfect example. Now again, what are we doing? We're taking a list of stocks from VectorVest. These are all good bullish candidates. Now we're judging them for their option. All of these over here on the right in my matrix have underpriced options. So we've got a nice list to choose from. We've narrowed it down from 100 to maybe about 50 with cheap options pricing. Now we're fine-tuning it even more. I want to see option premium that's cheap to buy but more expensive to sell to complete my bull call debit spread. Okay? And I think TXI right now is a very good example of what I'm looking for. Cheap at the money premium and more expensive high volatility out of the money where I need to sell it to complete it. From here, what I can do, I'm going to go ahead and close the matrix because we're going to work with TXI. I like this particular example. So we'll work with TXI. Another feature of OptionsPro is called the Spread Select. Over on the left-hand side of the screen, I'm going to click on Spread Select, and I'm going to input TXI into the Spread Select. So TXI, click on Load. Now, under the expiration, there's a Select Spread Type menu. I'm going to go ahead and clear it because I don't want anything chosen yet. Once I drop that menu down, you're going to notice there's all types of pre-built option spreads. Long stock, long call, we have them separated by whether they're bullish, bearish, or down here, neutral. Since we're doing a bull call spread, I'm going to go under my bullish, and I'm going to choose the bull call spread. Left click. Now, what this spread select is going to do, it's going to start building spreads for me. It's going to build spreads that expire on February 22nd with a starting price of $75. That's an at-the-money call. It's going to go out just one unit, or I can increase the number of strikes, 70 to 75, 75 to 80, up to $85. I can do it above, below, or both, which means at the money, above the money, out of the money, with a minimum range of 5. So I'm going to go ahead a little bit higher on this. We'll go out 2 strikes. So I've got 2 strikes both. That means below, that means in the money. 65 would be in the money. 70 would be in the money. 75 would be at. So that's 2 strikes below. And then you'll notice 80 and 85, that's 2 strikes above. Okay? Those are how the spreads are being calculated for me. Now, you'll have to pardon the low resolution we're running for our presentation. If I scroll this bottom bar to the right, what I want to show you is how it builds the spreads. If we look over here to the right-hand side, you'll see credit, which is how much the credit or debit, this is how much that spread will cost us to put on, $465 to do the $65 and $70 strike prices, my maximum profits on the trade of $35, and my maximum risk, which is $465. That doesn't look too good to me. I don't really like risking $35 or risking $465 to make $35. What I want to see is something a little bit more even. Take a look at this example right here. My maximum profits are $260. My maximum risk is $240. That trade creates a $240 debit. That's how much it'll cost me to put it on for one contract. So if you're trading 10 lots, just multiply it by 10. And we can do that in the risk graph to show you, multiple contracts. Here's one below. My maximum risk is $57. My maximum profits is $442.50. Now, if you're looking at this solely from a profit and loss calculation, that's pretty darn good. max risk of $50 with a max profit of 442. That's almost a 10-to-1 return. Now, what I want to do very quickly is illustrate, while even though it looks good on paper, it's probably not the best candidate. So what we can do from the spread selector, I'm going to double click on that particular spread because, boy, it looks good. A $442 potential profit versus only a $50 risk. I'm going to double click on that column and the software will load a risk graph with that particular candidate. Okay? Now, actually, this one does have some potential. Here's what I want you to look for when you look at a risk graph to do these bull call spreads. Now, the downside is that options are relatively inexpensive, so you're not saving a whole lot by doing this bull call spread. You're only getting 5 cents return on the option that you're selling. Probably in this case, you're better off just buying the call outright and not worrying about the credit. But here's what we want to look for when we analyze the trades. On the risk graph, I'm going to point out a couple different features of the risk graph. The first thing that I want you to notice, I want you to notice these green horizontal bars right here and right here. These are the probability bars. That represents a 1 standard deviation move. That's pretty attainable historically, a 1 standard deviation move. That's the minimum that you want to see. Now, when I pick a spread, I want to make sure that my maximum profit occurs within 1 standard deviation. And how do you do that? Well, take a look. I'm going to uncheck this blue line. I'll put that blue line back on there in a few minutes here, explain what that means. Take a look at the black line of your risk graph. That represents how much money you'll make or lose at expiration based on the underlying stock. So if my stock goes to $82.50 on the day of expiration, and I'll just follow that all the way up to where the black line is, I'll make roughly $191 on this trade. That's if TXI goes to $82 when this option expires on February 22nd, I will make $191. If the stock goes against me and maybe falls to $75 on the day of expiration, I would lose the $57.50. That's how you read a risk graph. Any price that's shaded by red represents losses. Any price shaded by green represents potential profit. Okay? Now, the reason that this trade looks so good from a risk-reward standpoint is, take a look at the options premium. The option premium is only 50 cents to buy. It's only 5 cents to sell. So you're not exactly getting a solid return on the bull call debit here. You're not really offsetting by much. That's why this has a good potential reward risk candidate. What I want to see is that maximum profit reached before 1 standard deviation. Now you take a look right here. My maximum profit occurs at $85. And you know that because that's the call you're selling. You're selling an $85 call in TXI. That's where my maximum profit would occur. So if this thing goes to 90, I'm still locked in because that's the option contract I sold. Okay? I want to make sure that that maximum return occurs before 1 standard deviation. What I'm going to do just to illustrate this, I'm going to take, instead of doing an $85 call, I'm going to do a $90 call. Now, you see the difference? On the $90 call, here's my maximum profit, and that maximum profit is greater than 1 standard deviation. You want to make sure, again, I can't stress this enough, that your max profit is within 1 standard deviation. This right here is a little bit too far of a spread. Now, from a risk-reward perspective, this thing does look great. You're doing a $12 debit, your maximum profits are $9.87, your maximum risk is only that $12, but in order to achieve that, you have to make more than a 1 standard deviation move. Okay? That's pretty big. Now, one of the nice little features here of the risk graph, I can actually chart right from the risk graph. I can click on my chart button. There's a chart of TXI. And I can actually add a probability envelope right to that chart. So you can kind of see how it lines up. I'm going to kind of compress the chart a little bit here. This is the February 22nd. A 1 standard deviation move, which you already kind of see. You see how it lines up, how I got the risk graph on the right and my one standard deviation on the probability curve, or on the probability envelope on the left? See how they line up 85, 75 right to my risk graph? I can kind of see how big of a move that would actually be on the chart. Okay? So you can kind of line them up just to see. I just wanted to show you that feature so you can see both of them at the same time. You can actually see it on the chart and how it lays onto the risk graph. So when it's time to put together these spreads, rule of thumb, make sure your maximum profit is obtained within one standard deviation. Now there's a couple other features that you can do with the risk graph. I had that initial blue line up. There was that blue line. This is what we call a scenario line. What I can do with that blue line is model different things. The black line is at expiration. What happens from just time decay? Right now we're 16 days from expiration. What happens when we're 10 days from expiration? On the left-hand column down here at the bottom, I can do it two different ways. I can either left-click in the number of days column, and I can just type in 10, or I can move my slider back and forth. And that represents, okay, now we are 10 days from expiration, and that is our current profit and loss line. Okay, I'm actually going to change this back to an $85 call so it's a little bit easier to kind of see. But do you see how as I move that slider bar for expiration, my profit and loss line changes? If we're 4 days from expiration and the stock's at $85, we're not going to achieve our max profits. We're actually only going to be at about a $364 gain on TXI. What happens if volatility drops? Well, over on the right-hand column, I can adjust volatility. If volatility, let's say, declines to 10%, I can move my slider bar until I see 10%. Okay? And you'll notice that the risk profile of the trade changes. What happens if volatility increases to maybe 25%? Again, I can move that slider bar over until I get to the desired volatility, and I can left-click and you'll see the difference in pricing models on this. So it helps us model different things. This is key for me, as I like to change the number of days so I can see how the trade plays out as we get closer and closer to expiration. Okay, so that's how we pull up, and that's how we would interpret a bull call spread. Just to review what we covered in the bull call spread. Step number one, I take the symbols from VectorVest. If you recall, I did a scan on VST Rockets. I launched the OptionsPro software, loading the bull call risk graph. From there, and I can close this just to kind of run you through this. From my symbol list that I imported in from VectorVest, I went and sent that to my matrix. I did a scan under Advanced Scan for stocks with underpriced options. Now, when I did the initial demonstration, I pulled up a chart to show you what it was looking for. Again, you don't need to do that because now you understand the concept of overpriced versus underpriced options. These are all underpriced options. And then from here, I looked for good candidates based on option skew. I tiled my screen so I could see them both together. I chose them to be grouped up. That way I could just go right through the list. I came to TXI. I noticed that the at-the-money options right around 80 and at 85 and 90 had a much higher volatility. So I thought this was a more appropriate candidate because the option that I'm buying has low volatility, like the scan showed us. The option that I'm selling to complete the bull call spread had a higher volatility. That means I get more of a return on the selling leg of that trade. From here, now that I know TXI was a good opportunity, I went into my spread select. I had the spread select put together some spread examples for me with that February 22nd expiration, and then I chose bull call spread, and I essentially went through the list looking for potential good reward risk candidates. And then from here, I analyzed those by double-clicking on the particular spread that I liked, and I analyzed that into my risk graph. Okay? So A few takeaways from our class today. Options trading, all about volatility. When you're doing a credit spread, we want to make sure volatility, that implied volatility, is at a much greater rate than historical. I showed you how that we showed that on the chart using the DT volatility comparison. We talked about how we scan for it using the matrix with covered calls. When you're doing the debit spread, we talked about how low volatility is important, how it was illustrated on the volatility comparison study, how to scan for that using our matrix with underpriced options, how the skew comes into play when you're doing a bull call spread, how theta decay comes into equation when we're doing the covered call. So I hope this was a good tutorial for you. I hope you learned something from it. Again, VectorVest and the VectorVest OptionsPro integration. Thank you and have a great day.